Hey traders, candlestick patterns are one of the most important concepts when it comes to trading profitably, yet you'd be surprised that most beginners still use them incorrectly. The most confusing part about trading candlestick patterns is figuring out which ones actually work, since there are a lot of them. But here's the truth, 99% of these patterns don't actually work, and I know this because I've tested all of them throughout my trading career. However, I've found that a handful of them worked extremely well, and to this day have made me a lot of profit. In this video, I will reveal the only 5 candlestick patterns beginners actually need to know. So, without further ado, let's dive right into it. The first pattern you need to know is the bullish engulfing pattern. An engulfing pattern is a candlestick pattern made up of 2 candles, a smaller first candle followed by a larger candle of the opposite color. A bullish engulfing pattern is when the smaller candle is red and the larger candle is green. The key point is that the body of the second candle needs to fully cover the body of the first candle. When you see this pattern on a price chart, it could signal a potential trend reversal to the upside. This is because the pattern shows that buyers have grown stronger, as seen by the large green candle pushing the price higher than the previous red candle, indicating a possible reversal. If you see a valid bullish engulfing pattern form, you can enter a buy position at the close of the large candle with your stop loss set at the bottom wick of the green candle. The second pattern is the exact opposite, the bearish engulfing pattern. This occurs when the smaller candle is green and the larger candle is red. The second candle's body completely covers the previous candle. What this shows us is that at first, buyers pushed the price all the way up, but then sellers stepped in and started pushing the price back down, even as far as surpassing the previous candle's opening price, which indicates that there is a strong selling pressure at this area. When a bearish engulfing pattern forms, it could signal a possible downward reversal, as the large red candle indicates that sellers have gained strength over buyers. If you spot a bearish engulfing pattern, you can enter a sell position at the candle's close with your stop loss set at the top wick of the red candle. Moving on to pattern number 3, which is the doji. A doji candle is when a candle has a very small body and 2 shadows. Whenever you see this shape, it signals neutrality in the market. If a candle has a small body and equal wicks, it indicates that neither buyers nor sellers are in strong control. Both buyers and sellers tried to push the price up and down during this period, but neither side was significantly dominant, so the candle closed near its opening price. A trend will not last forever, and eventually it will start to weaken and reverse. So finding reversals using the doji candle is very effective. The first step is to find an existing trend. The next step is to find a doji candle within that trend. And the next step is to wait for 2 huge candles that are in the opposite color of the trend to appear. This will be your entry signal to take a buy or sell position. Pattern number 4 is the hammer. This is essentially a bullish pin bar, which is a candlestick pattern made up of just 1 candle, characterized by a large wick on the bottom side and a small body. The hammer indicates rejection, as shown by the long wick on one side. What this tells us is that at one point, sellers tried pushing the price all the way down, but before the candle closed, buyers started coming in and pushed the price back up, indicating that there's a strong buying pressure at this key area. This shows that while both sides were active, buyers ultimately came out stronger. I prefer to wait for another green candle to form to confirm the trend, and once the trend is confirmed, you can take a buy position after the candle closes and place a stop loss at the bottom of the pin bar's wick. Finally, pattern number 5 is the shooting star, which is a bearish pin bar. The shooting star pattern indicates rejection, as shown by the long wick on the top and a small body. If you see one forming, it means that buyers initially took control and pushed the price up, reaching a high level, but sellers ultimately rejected this upward move and drove the price back down considerably before the candle closed. This is why a long upper wick indicates strong selling pressure. For this setup, you could wait for an additional red candle to form for extra confirmation. Then you can look for a sell opportunity with the stop loss placed at the top of the pin bar's wick.
Now keep in mind, when traded on their own, these candlestick patterns may not always be as effective. However, if you combine them with other forms of analysis like key levels, they can become much more powerful. You cannot blindly enter a position just because the price made a pullback towards a level, as prices can still break through it. You need to use these candlestick patterns to confirm that the price will actually reject the level. For example, if you see a hammer forming at a strong support level or a 50-period moving average, this makes it an area of high confluence and a much better trade opportunity. For your risk management and exit strategy, after you place your stop loss at the wick of your entry candle, you want to set your profit target at 2 times the size of your stop loss. This ensures that your winning trades are bigger than your losing trades and will help you grow your account consistently. I just revealed to you the best 5 candlestick patterns that you can immediately use right now, and all I ask for in return is for you to invest 2 seconds of your time into liking the video and subscribe to the channel. It literally takes only 2 clicks, but it means so much to me, and you can also check out my other videos as well. Thank you guys for watching, and I'll see you in the next one.